Welcome back, everyone. Peter, very good to see you. A big story today. A very popular financial guru proposes an 8% withdrawal rule, but is that realistic? So recently on his popular show, a well-known financial expert dismissed the common advice to withdraw only 4% of your retirement savings annually as, quote, moronic, advocating instead for an 8% withdrawal rate. He argues that this rate, adjusted annually for inflation, can be sustained without eroding principal balance. So the financial world exploded when he said this. Peter, what do you think?
Well, it was Dave Ramsey, and Dave Ramsey is not known to hold punches. And just in full disclosure, I am a Dave Ramsey SmartVestor Pro, and I believe in his teachings. There's no other documented financial system that I am aware of that has gotten more people out of debt, building wealth, and financial success, even millionaire status, than Dave Ramsey's baby step system. So it works. However, there are places where you have to take things with a grain of salt, or it might not apply to every situation. And I believe that baby steps 1 through 3, where he's talking about getting out of debt, pretty much apply to anyone in that situation. And then baby step 4, where you start to invest and build wealth, that's when he directs people to go see a SmartVestor about their individual situation and the allocation or the investments that are best and most appropriate to help them achieve their financial goals. And I think that his teachings really are for a kind of description of person who is trying to make that progress, maybe not for somebody who is at the position and point of making the transition to retirement. So here's where the grain of salt in the gray area is that I think that his approach for investing when you are trying to make as much progress as possible is probably, again, appropriate. But when you get to the point where you have achieved the success of the ability to retire confidently, again, that is not what his program is specifically dedicated to. And he's got a commonly held theme where on his program, he says that invest in good growth mutual funds and you should beat the market or average 12%. We really need to examine that number alone, because that is not what has been shown to be true over the last quarter century, even with the S&P,
Right.
or index funds or mutual funds. And then even if it were, an average rate of return is not what you need to be relying on in retirement when you are making withdrawals. And even his daughter was on the program with him, immediately raised questions about this and sort of called out his advice, and again, not holding punches, calling this a moronic guideline. I don't think it is. I think that this is a starting place for people to reference when they are looking at how much cash flow they can generate in retirement. And let's face it, for Dave Ramsey in retirement, even if there was a 50% loss and he was taking money off of his investments, there would still be enough capital there that he would be comfortable. But for most people, if we had large losses or we're taking too much cash flow off the top, adjustments down the road when things have already happened or when we get to the realization that we're withdrawing too much, that's life altering in a way that it would not be for Dave personally.
Right. Good point. All right. So Ramsey also recommended that retirees invest all their assets in equities. And of course, I think a lot of people hear that thinking, isn't that going to expose you to a lot of risk and market volatility?
It absolutely would. And there's kind of an older theory than even Dave's advice, which is the modern portfolio theory. It's not so modern any longer. It's probably 67, 68 years old, almost retirement aged itself. But it says that you take your age, and that is the percentage of assets that you should have removed from the risk of market exposure and equities, and more in something safe, secure, fixed income bonds, bond funds, and the like. And the rule of 100 gets more specific on that exact ratio in the modern portfolio theory that says some stocks are appropriate, but how much? And then the rule of 100 says, well, basically 100 minus your age is the amount that may be appropriate to keep in equities. But even that is just a rule of thumb. And the reason why is exactly what I pointed to earlier, which is that somebody who is on the verge of or on the cusp or already in retirement, seeing a large market correction during that phase of our life could be absolutely life altering. In other words, a 60 or 65-year-old should not be taking the same kind of investment risk as a 30 or 35-year-old.
Right. Okay. So then on that note, Peter, when can an 8% withdrawal rate be sustainable?
Well, when we know that the entire future of the market is going to be up, and at a rate of 8% or greater, but nobody knows that. So that's why there's so much doubt and worry. And on the screen right now, there is a report calculator from Vanguard, which is really famous for kind of do-it-yourself investment calculators. And this shows the 4% withdrawal rule kind of projected out through thousands and thousands of different potential outcomes, the Monte Carlo simulator. So $1 million over 30 years, generating a 4% cash flow. What is your probability of success? And this Vanguard retirement calculator gives us a 91% probability of success. In other words, the potential of up to a 9% probability of failure. And if the weatherman comes on and says, there's a 9% chance of rain today, I might feel comfortable leaving my house without my umbrella. But if my financial plan for retirement is based on a theory or a cash flow that gives me a 9% probability of running out of money over the likely longevity within retirement, I'm really going to examine that very carefully and try to figure out how to avoid that 9% probability of failure. And so kind of to further on Dave's point, the slide you see on the screen now, it's got a lot of numbers on it. And this is for those that are viewing our podcast. If you'd like to go to YouTube and check out these visuals, if you're listening on the radio, here's the situation. It is that same $1 million starting value. You take out an 8% cash flow or $80,000 per year. And by the end of 10 years, specifically with the market returns from 2000 through the end of 2010, you are out of money by the 10th year, taking Dave's 8% cash flow withdrawal rate rule. Now, I have those that would say, well, 2000 to 2010 was a really bad decade. Sure it was, but is it the worst case scenario? No, it's not. And most of my clients want their plan to work under a worst case scenario. Or
that should be our math. I feel like that should be your base.
Or at least project out to where it works under adverse conditions, evaluating the fact that we can see market volatility. And by the way, 2000 through 2010 is not the worst decade of market performance. There have been plenty of times where it's been flat. Okay, so let's try another scenario. Let's try a 5% withdrawal rate. Same time frame. If we start with $1 million and then take $50,000 a year, by the end of the 10th year, we've got only about 38% of our starting value left, $382,000. Now, I don't know when in my retirement timeline I'm going to be comfortable seeing less than half of my starting balance, but it's certainly not after 10 years, right? So now we go to that 4% withdrawal rate scenario. And this illustration now on screen shows the 4% withdrawal rate rule as it is stated, which is that you adjust for inflation each year by about 3.5%. So we start with 40,000. By the end of 10 years, we're taking out 53,700. But again, we have less than half of our starting value after just 10 years. And inflation is going to be a factor. So we need to factor that in. Another way to look at the 4% rule, and I think this is what Dave may have meant more with when he said 8% is a safe withdrawal rate. If we flash that final illustration up on screen, this is 4% of whatever the balance is that year. And after 10 years, we do have more than half of our starting balance. In fact, the $1 million produces income for 10 years. And after 10 years, we have $668,000. taking 4% of the balance each year. But the problem with that one, Erin, is that the income is never the same. And most people's expenses don't go up and down with the market. So there are some years there where we actually are able to generate less than half of the income that we thought we were going to be able to generate. The income fluctuates far too much for a reliable retirement income plan. And so
Mm.
we really need to carefully evaluate and examine not only the cash flow that we need, but the tools that we are using to generate that cash flow.
Hmm. Which is why even the 4% rule itself is under debate.
Yeah, so this has been around now for, I mean, close to 40 years.
Hmm.
A financial analyst by the name of William Bengen incepted this 4% rule, and air quotes on the rule there, this theory of a 4% retirement cash flow rate. And he did that during the early 90s when the market was on a tear, interest rates were pretty attractive, and back testing it even through some more adverse conditions, he said it worked out, and that's what that Vanguard calculator was based on. However, interest rates have not stayed as high. The market has become more volatile. And so during the 2000s, there was a lot of articles and financial institutions that came out and examined this 4% rule and said, really, this is way too dangerous for most retirees to be able to handle. And by the way, it fails way more often than that Vanguard calculator 9% projection. There was a
Hmm.
lot more danger with that 4% rule. Well, the problem was the model that they were using, because interest rates were low and they were basing that on a market that had been very volatile. Today, we have higher, more attractive interest rates and payouts. We can actually get above a 4% cash flow rate guaranteed for life in the case of annuities, fixed index annuities with guaranteed lifetime income riders. So if we can get a 6% cash flow versus a 4% cash flow, that's 50% more income, and we can use less money to generate the same kind of income that the 4% rule once projected out. Now, William Bengen, I've had him on our program and interviewed him before, and he gave two disclaimers on the rule. Although he said he was still comfortable saying 4% probably is the right kind of cash flow, he said, number one, that it completely ignored the potential of a large market downturn early on in retirement. Well, we don't know when a large market downturn is going to occur. We certainly don't know beforehand. So timing that retirement with that potential just can't be ignored. And that's why one reason why the 4% rule isn't applicable for most individuals. And the second was specifically that William Bengen said that the 4% rule that he incepted was always meant for institutional investment, meaning like pension funds, where the law of large numbers helps out. We're not talking about one person in their retirement nest egg. We're talking about hundreds, if not thousands of people, and projecting out cash flow where some outlive life expectancies and some don't. So one individual cannot rely on the same kind of guidelines that institutional and pension fund investments can for generating income and cash flow.
All right. So, Peter, everybody's watching and listening and say, okay, get to the point. How do I find my correct withdrawal rate? How do you help clients find what they should be withdrawing? And then how often should they revisit that number?
Well, they should revisit it every year. They
Wow.
should do an
Okay.
annual review. A retirement income plan is not etched in stone. It is a guideline, but you need to monitor the path, and sometimes you need to readjust. Hopefully, we set off into year one of retirement aiming for a good target, knowing what we are aiming for. And so having good guidelines in place that into the future, we've sort of planned and mapped out for a worst case scenario, and we can go up from there, not having to pull back on lifestyle. But I don't really look at this the traditional way of, well, the mutual funds have averaged this, and so you should be able to withdraw that, because the rate of return in no way is indicative of the amount of income that you can sustain and withdraw from a portfolio. That is another one of those misnomers. And I could work that out in more detail, but just take it for face value that your average rate of return is not the rate of withdrawal that you can take. And so what I really look at when mapping this out and putting together that optimized retirement plan for people is a reverse engineering approach where we look at what are your expenses that you need to cover? Let's subtract out other sources of cash flow that we can count and rely on, like Social Security and or pensions. And then what is the income gap left over? And where can we go out and generate a sustainable, reliable cash flow to fill that income gap with as little money as possible, hopefully leaving as much left over for discretionary funds and for investment with the risk of the market, but the potential for growth as possible. We want as much money there for investment as possible. We want as little as needed to generate the income, but you've got to work that on an individual, very specific to you kind of basis, not some general guidelines, in my opinion.
And just to bring this all home for everyone, this is critically important, figuring out your unique withdrawal rate, because this is what ensures that you don't run out of money in retirement.
Yeah. And let's factor in inflation. Let's factor in taxation. Let's factor in the potential for bigger expenses later on in life, like healthcare expenses. That's why we put together that optimized retirement plan, Erin. It's exactly this issue: how to make the transition into day one of retirement, but with financial confidence that you can make it into the next decade plus, decades ahead of you, with sustainable, reliable kind of income. The optimized retirement plan looks at income, investments, taxes, healthcare, legacy. My job for my clients is to help them manage the investments, but it's got to fit into that picture. And every plan for retirement at a high level should address at least those 5 items. I think that it's critically important. That's why we offer to put that optimized retirement plan together. No cost, no obligation. Give us a call if you would like to take advantage of that. See your optimized retirement plan. 919-300-5886, 919-300-5886. You can go online. It looks like richonplanning.com. It's my last name, richonplanning.com. You can email me, peter@richonplanning.com. Look, get a plan put together. That is the way to answer and address this question, and not just one that speculates on future rates of return of the funds or the stocks or the equities themselves, but one that looks specifically at actually generating retirement income, looks at the risks, the issues, the opportunities that are available to do that. And by the way, opportunities right now today for generating retirement income are very attractive, very advantageous. Cash flow rates are available. I would really take a look at this if you're planning on retiring in the next 5 to 10 years, or even if you're already retired. Right now is a great time to look at retirement income cash flow generation.
I always love diving into the headlines with you, Peter. Thanks so much for your time today.
Yeah, well, this one was widely debated. It was a good topic to talk about.
Fired up. People are fired up. All right,
Absolutely.
Peter, thank you.
All right, thank you, Erin. Hey everyone, Peter Richon here. Hope you enjoy the content. As always, make sure that you like, subscribe, share the videos with others that may find this information helpful. And as always, you're welcome to be in touch or to submit questions or comments. You can comment below the video anything that you'd like to see or hear shared on our YouTube channel and in future videos. If you got a topic that you've been thinking about or is of concern for you financially, be sure to let us know. We'd love to help you by discussing it on the channel. So appreciate the continued views and the likes and the subscribes, the shares, the comments, always helpful. We look forward to getting you the information that you need.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.